Hey guys, Steve Ferguson here, your modern mortgage loan advisor. Thanks so much for tuning in today. I'm excited about what we're going to talk about today because today I'm going to give you 5 creative ways to buy rental property. That's right, 5 different ways, outside the box ways. They're going to get you excited about buying rental property. And now before I get started, please like or subscribe to my channel. Click that button. Remind yourself to check out my videos. I want to make sure you guys are up to speed on everything. I'm a huge fan of educating you on the different programs that are available, different ways to make money for you and your family and to spend money the right way using mortgages. So thanks again for clicking that like or subscribe button. All right, let's get this process started. So the very first thing I want to go over with you guys, and I made a list over here on this side, so you may see me looking over here because I want to make sure you guys get every detail, is if you own a home now, we can use a HELOC or a cash out to pull that free equity, because that equity is free, let's be honest, out of your current home, and we can leverage that money to allow you to buy your next rental property. Now, here's the really cool thing about using the HELOC or the cash out. One of those 2 options to pull financing or to pull funds out of your current property. Number one, it's a tax-free item. So when you do a refinance and you pull that cash, you don't get taxed on that cash. Now, my disclaimer is visit with your CPA to confirm, but generally speaking, that money should be tax-free. Now, I can take that amount of money, however much money it is. If I've got enough to put 20% down on an investment property, or if I've got enough money to pay for it in cash, that decision is your decision to make. You've got a better interest rate on it because it's attached to your primary residence versus the investment property. It'll make your investment property cash flow better. It's going to make the mortgage part easier to finance. So there's a lot of benefits to that. Plus, that equity position is probably a free situation for you. Unless you bought that home and rehabbed the entire thing and threw a bunch of money into it and that built your equity, most likely you have equity because you've owned the home over a certain period of time. And just the value of houses has increased over that time. So that means when you wake up in the morning, hopefully you made a little bit of money by sleeping because your home is now worth a little bit more money. So take advantage of that money. Use that stuff to get the equity out, and that way you can buy rental properties with it and grow your wealth. So that one's probably one you already knew. The second one, you may not have known. So number 2, I call that hacking with multifamily properties. House hacking, multifamily properties. So let's say you haven't bought a home yet, but you want to buy a home and you want to get rental properties right away. You can use an FHA loan or a VA loan, and you can buy a multifamily property up to 4 units. You can live in one of those units, and you can rent out the other 2, 3 units that are attached to that property. If it's a triplex or even a duplex, one other unit. And you can get rental income from those units in order to start building wealth. Now, the other cool thing about that is we can use anybody that's currently in those units renting with a long-term lease. Their rental income can go to offset that mortgage payment for you. So it's going to allow you to qualify for a bigger mortgage loan, which is really nice because we all know multifamily properties can cost a little bit more money. So now you've moved into the property, you live in it, you get owner-occupied interest rates, low down payment. FHA is as low as 3.5% down. VA is as low as 0 down. And then you've got some cool neighbors living next to you that are helping pay your mortgage payment. You're getting the tax benefits. You get to learn how to be a landlord. And guess what? You live in that home a couple of years, you're like, you know what? I'm done living next door to my neighbor. I want to buy my own single family residence. You can move out, buy a single family residence and rent out the unit that you were occupying. So you've increased your rental portfolio in a very short amount of time, very little money out of pocket, excellent interest rates, 30-year terms that make financing a breeze, for lack of a better description. If you're an investor and you've done some of this before, you know how valuable that can be when you're owner-occupying investment properties because of the simple terms and benefits you get, which makes you cash flow better. Okay, so that's number 2. Let's go to number 3. Number 3 is a little outside the box, guys. You guys may never have heard of this one. It's called being a money partner. All right. Now, I would say that this version is probably a little more geared to somebody who's a seasoned investor because you have to be careful with this one. I'm giving you guys a disclaimer. A money partner means, hey, I've got a buddy of mine who's got cash, but he doesn't want to manage rental properties. I've got time. I want to manage the rental property. I'm going to make sure that everything gets done. And so my money partner pays for the rental property. I come in and I manage the rental property. We become partners, essentially creating a business together. We each bring something to the table and we work that angle of it. Now, I do recommend being careful with this because you want to partner with somebody you can trust, right? Both of you guys need to do the equal amount of work. If one person's bringing money, the other partner should be doing everything else because they're not bringing money to the table or very little money to the table. And then make sure you have everything in writing. So for example, if you guys are going to agree to this, you want contracts that are rock solid. That way everybody knows what their entrance is, what their exit strategy is, what their responsibilities are. That way, if anything comes up in the future that you have questions about, you can refer back to your contracts that you guys have put with each other to make sure that you're doing what you need to be doing. Now, this can be a very lucrative way to scale business because there's lots of people out there who have money that they need to invest without the knowledge. And there's people that have the knowledge of investments but may not have the cash. So you guys can partner with each other to figure those details out and hopefully create something that would be profitable for both of you guys. And then that way you have solutions that you may not have ever thought of to buy rental property. So this may be something you guys want to talk about more, that number 3, but be aware it is available. Number 4, I like this one. This one's pretty good. Using a seller financing or subject to deal. Now there's a lot of people out there who teach how to do seller financing. We call them lots of different things, but subject to is kind of the general acceptable term. So that means I'm going to a person who has a house that they need to sell, or they may be distressed, or they may be in a position where they just don't want the home anymore, whatever it happens to be. And you're like, look, I'm going to take over your payments, or I'm going to buy this home from you, but I need you to owner finance this property. That means the seller is going to say, okay, I'm going to be the bank. I'm going to sell it to you. You put X number of dollars down, and I'm going to sell it to you at this interest rate, and you make me payments. Now, those are really cool because it creates little money out of pocket for you as the investor. So you don't have to worry about writing big chunks of money, all those things. It's really about who you negotiate with and what they're comfortable with. I've seen these deals go from 0 money down, where people are just taking over payments, to 20% down to get people comfortable. Just know it's between you and the seller as you negotiate those things out. I always recommend closing at a title company, so that way you know that you're on title as the investor. The seller is no longer on title because they're the seller. You also have to be very careful for due on sale clauses. So if the seller has a mortgage, there's always what's called a due on sale clause, which means if ownership transfers from one person to another person, then that lender can call the note due. So be aware of those things. There are some pitfalls in this. However, if you do it right, you put it together the right way, it's going to get you into a rental property with very little money out of pocket. You can put a renter into that property, you can get some cash flow going on, and you've achieved an equity position with a tax write-off for you for your tax returns with very little money out of pocket. So again, this is another viable option that I see a lot of investors use in order to get into rental properties. I know some people that scale this quite a bit, and there's a lot of different people out there that teach how to do this using lots of different methods. So my goal for you today is educate you and let you know that it exists. So just be aware, if you know somebody that's got a house that's distressed or wants out of it or can't sell it, it may be a viable option for you. All right, the last one, number 5. This is one of my favorite loan products. It's called a DSCR. So a DSCR loan means, let's just say that you want to buy an investment property, you're employed, but you don't show enough income to carry your current mortgage and the new investment property, and you're trying to find a way to qualify for it. We call that a DSCR loan, which is a debt service coverage ratio loan. I'm going to tell you again, debt service coverage ratio loan. Here's how this works. Here's how the math computational formula gets put together, okay? So if you buy this home, you put 20% down, which is your standard down payment for most investment property, and the mortgage payment is $1,500 a month. As long as the home rents for $1,500 a month, that's called a 1-to-1 ratio, you qualify. That's how they determine your income. Now, you do have to meet certain credit score requirements. You got to meet asset requirements. You've got to have the funds. There's several factors here that you have to consider when you're looking at a debt service coverage ratio loan, but it does give you flexibility not to have to provide tax returns, no W-2s, no pay stubs, none of those things. So we use this program quite a bit to get investors in these loans because it allows for more finance properties. You could do 8, 10, 15. I mean, I think right now I have the ability to do 40 DSCR loans for an investor right now if you wanted to do it. So you can scale your business in a short amount of time. And then you also don't have to prove income other than the fact that the home rents for your mortgage payment. And then you can also back into that mortgage payment. So let's say the rental amount was $1,500, but the mortgage payment was $1,400. You can put more money down in that mortgage to get it to $1,400 a month, and then you're fine. So that's a super cool way and a very flexible way to get into rental property, scale rental property without using your traditional ways of financing. Now, guys, that's 5 different ways. Let me tell you those 5 ways again. I'm going to review them one at a time real quick, okay? So number 1, HELOC or cash out your current property. That's super easy. One of my favorite ways to get this done. Low interest rates, low closing costs, tax-free money. That's a winner. Number 2, buying multifamily property. If you don't own any home right now, you can move into the property, rent out the other units that are attached to it, low down payment or no down payment, less than perfect credit works on those programs. It's a great way to build generational wealth from the very beginning. Partnering up with a money partner. Again, that's probably one of the higher risk ways to get this done, but it is certainly available. Choose your people wisely. Make sure you get everything in writing. And it's a great way to generate some wealth for both of you guys. Seller financing or subject to. That's a great way to get in front of people, to get it taken care of. Create an exit strategy, because most people will want you to make sure that you refinance out of that program in a specified amount of time. But you can get the benefit of using appraised value if you've owned that property for a year after they sell or finance it. So there's some exit strategies there as well. So very cool deal. And then the DSCR, which is a non-QM loan. Again, one of my favorite from an investor standpoint. Easy way to get into the investment market. All you got to do is check your rentals and make sure you can get it bought right. And then your incomes are relevant. It's all about the property. And you can even close in the name of your LLC if you want to at that point in time. So anyway, guys, hope you enjoyed these 5 different ways to get into investment property. They're outside the box. There's other traditional ways as well. But I want you guys to be thinking on your toes as you're out there looking for investment property. Now, if you want to go over these options about your personal situation, reach out to me. Drop comments in this video. I'll run specific numbers for you. And that way you can make an educated decision as to whether or not this makes sense. You're welcome to request, questions on the comments or whatever it happens to be. Let's get you set up for success so you're making great decisions. Thanks again, guys. Don't forget to like or subscribe, and I'll talk to you later. Bye-bye.